And to discuss Bitcoin policy, Senior Advisor to the BPC and the President of the Foundation for Research on Equal Opportunity and Fellow at Bitcoin Policy Institute, Avik Roy.
Good morning, everybody. It's great to be with you today in my hometown of Austin. I want to thank Lee and Natalie and the team for bringing me here to speak with you today and to get to see so many of you. As you know, or as many of you know, I only came out publicly as a Bitcoiner in 2021 after I published my national affairs piece on Bitcoin and the US fiscal reckoning. I never would have expected that a 6,000-word essay with 0 pictures and 2 charts would get so widely read. I'm so grateful for all the amazing people in this community that I've gotten to know since then. It's crazy to think that it's only been a year. I first became interested in the intersection of monetary and fiscal policy in my previous life as a hedge fund manager. It's kind of a cliche because so many people today dismiss these topics as ones for bankers and finance people and people like us. But when the 2008 financial crisis upended the fiscally fragile economies of Portugal and Greece and others, the people who were most harmed weren't the bankers. It was the grandmothers who could no longer afford their groceries. It was the 20-somethings who couldn't find work and gave up trying. Portugal and Greece were lucky. They had the European Union to bail them out when they fell in hard times. What you may not know is that today, in the United States, our debt to GDP ratio is actually higher than Portugal's. And our economy is the largest in the world. So who's going to bail out the United States as we increasingly struggle to finance our debts? On the day that Satoshi published his white paper, the federal debt was $10 trillion. Today, it's $30 trillion. Within a generation, the debt could easily exceed $100 trillion. Credit Suisse estimates that the financial wealth of the entire world is about $250 trillion. Within our children's lifetimes, we will literally run out of other people's money. As I sat in front of my Bloomberg terminal in 2008, I hadn't yet met my wife. I didn't yet have any kids. But I knew that the future of my children to be was going to be determined fundamentally by whether or not we made enough progress on the existential threat of the federal debt. People our age might make it to retirement without a catastrophic economic crisis, but our kids won't have a chance if we don't get our fiscal and monetary houses in order. And if we don't, it'll be the most vulnerable members of our society, those with the least to fall back on, the elderly and the disabled and the poor, those who most depend on government assistance, who will face the greatest hardships. That's why 10 years ago, I walked away from the hedge fund business to do my part to help our elected leaders and a handful of presidential candidates to try to solve these problems. It turned out that the biggest driver of our debt and deficit was federal healthcare spending, and I happened to have spent the bulk of my career up to that point investing in companies that were the recipients of that federal healthcare spending. So I had some ideas on how we could turn things around. The policy failures of the 2010s taught me one thing above all, that we won't make any real progress on getting our debt under control unless we find a way to bring Democrats and Republicans together. I came to appreciate that the best way to bring people together in turn was to find ways in which economic freedom can improve the lives of lower and middle income Americans so that we can reduce federal spending while actually improving outcomes and expanding opportunities for those who today rely on that federal spending to get by. Today, as you've heard, I run a think tank called the Foundation for Research on Equal Opportunity, or FREOP, headquartered 14 blocks from here in Austin, Texas. We work on a dozen major policy issues, including healthcare, education, energy, housing, immigration, trade, and criminal justice. In 2020, at the height of the pandemic, I can honestly say that no think tank did more to make the scientific case to federal, state, and local leaders that we could safely reopen schools and the economy. At FREOP, we also work on financial regulation, macroeconomics, Bitcoin, and digital asset policy, which is obviously why I'm here. I tell you all this about where I'm coming from because today, as you know, our community faces the greatest challenge of its 14-year history. If we make the wrong choices, even over the next few weeks, months, and years, we won't just fail the enterprises in this room. We'll fail the hundreds of millions of Americans and billions of people around the world whose futures depend on our success. The reason we're all here is because a sound, resilient, and censorship-resistant monetary system will do more for the prosperity of Americans and the world than anything else we can imagine. It'll empower Americans to protect themselves from the devaluation of their purchasing power by the US government. The companies in this room don't merely represent a sector of the economy. You're a part of the most important social movement in the world. When you ask people what they think the American dream is, a lot of them will say, the American dream is the opportunity to work hard to help my kids and my kids' kids have a better life than I did. But fewer people today believe that their lives are better than their parents' lives have been. 2% is the Federal Reserve's official average inflation target. But even 2% inflation over a generation decreases the purchasing power of the average person's cash savings by 40%. At 8% inflation, which is the official rate today, it only takes 8 years to have someone's purchasing power. And all those figures assume that the government is actually measuring inflation accurately. Ordinary people don't have giant houses whose value goes up when the Fed floods the market with money. Ordinary people get stuck with rents that go up faster than their wages do, and down payment requirements for home ownership that are even further out of reach as home prices go up. Ordinary people don't get to be venture capitalists because they lack the $1 million in net worth or the $200,000 in annual income that under SEC regulations they're required to have to be called accredited investors that can get in at the ground level and invest in promising tech startups like yours. Ordinary people are counting on you, the builders of the digital asset ecosystem, to help them protect their hard-earned savings from the ravages of inflation, whether they've saved $500 or $50,000. That's why the events of the last week are so dangerous for our cause. We all know that Bitcoin and crypto are not the same thing. We all repeat until we're blue in the face, not your keys, not your coins. But the average person doesn't know the difference between the anti-fragile Bitcoin monetary network and the worst fly-by-night crypto Ponzi schemes. The average person doesn't have the confidence that she can safeguard her private keys without losing them. The average person wants to know that the law protects her from losing her savings when a company screws up. If we want Bitcoin and digital assets to serve their highest purpose, then we need to make it possible for ordinary people to trust all of you, the people who secure the Bitcoin network, the people who make inflation-resistant digital assets accessible to those with $500 to their names. If we're going to turn this niche of ours into something that really makes a difference for the world, it's not enough to tell people to do their own research. The average person doesn't have the time to read white papers or to learn the ins and outs of fractional reserve banking. The average person operates on trust. And because of the events of the last week, that trust is shattered. You know, people in the 1930s knew how to hold onto their own keys. But back then, they didn't call them keys. They called them mattresses. People became so mistrustful of banks during the Great Depression that they hid their savings under their beds, hoping they wouldn't get robbed. And yet, strangely, we don't celebrate the 1930s as a golden age of financial self-sovereignty. We remember them as a time of fear and breadlines and unemployment and war. People weren't that excited about the opportunity to store their money under their mattresses. It created a greater risk that their homes would get robbed. If you died, you had no assurance that your savings would get passed on to your children. But during the Great Depression, people had no choice because banks were unsafe. Today, people do have a choice, thanks to the establishment of the Federal Deposit Insurance Corporation, or FDIC. Since 1933, there hasn't been a single instance of depositors failing to recover FDIC-insured funds. You can rant about growth in the money supply and negative real interest rates until you're blue in the face. I certainly do. But the fact is that when it comes to basic things like knowing that banks will give back your money when you ask for it, the traditional banking system is far superior to the crypto banking system of the last week. And before you start telling me about cold storage and multi-sig, Know that the average people, they like the fact that if they lose their ATM card, they can cancel and get a new one quickly without losing their savings. People like that forget that if they forget their bank account numbers, they can present their driver's license to the bank teller and use other personal information to verify their identity. Some of my favorite politicians are in this room, and politicians invest an enormous amount of time and resources into figuring out what people want because that's what we incentivize them to do. And I promise you, if you ask any of them, what they'll tell you is yes, people want freedom. People want the autonomy to live lives the way they want. But people also want to live in a world where they can trust the financial services that they use. They want to know that their life savings are safe when they go to bed at night. You know all this because this is what Bitcoin is supposed to be about too. In that context, the FTX debacle is the worst thing that has ever happened to our movement by a wide margin. When Mt. Gox went down in 2014, Bitcoin was way more obscure than it is today. Fewer than 1% of Americans had ever mined or bought crypto. The Ethereum ICO hadn't even yet taken place. In contrast, over the last year, FTX's logo was plastered on championship stadiums, on baseball uniforms, and Super Bowl ads. FTX has over 1 million creditors. It doesn't matter that the rest of you are working on better and sounder projects. It doesn't matter that you preach self-custody. It doesn't matter that you never believed in Solana. To the average non-orange-pilled American, let alone the average politician, FTX equals crypto, crypto equals Bitcoin, the whole thing is a scam. What the worst actors in our space do affects the reputations of the best actors in our space. And don't be fooled, our reputation matters. If we want Bitcoin to make everyone's lives better, it matters whether or not people trust Bitcoin. And it especially matters what Washington thinks of Bitcoin. Yes, the Bitcoin network will continue to operate regardless of what regulators do or don't do, thanks to all of the incredible companies in this room that keep the blockchain humming every second of every day. But if people want to buy Bitcoin en masse, they need to work with businesses that are legally allowed to exchange US dollars for Bitcoin. It needs to remain legal for legacy financial institutions to own Bitcoin. We all cheered when Michael Saylor put MicroStrategy's balance sheet into Bitcoin. But it'd be a relatively simple thing from a legal standpoint for Congress and the SEC to bar publicly traded companies from owning Bitcoin. Washington can't ban Bitcoin itself, but Washington can make it impossible for Bitcoin to be widely used. So to put it simply, we won't succeed without our reputations. And the tough part is, as FTX shows, our reputations aren't entirely up to us. So how do we rebuild trust and confidence in what we're trying to build? Believe it or not, the 1930s have a lot to teach us in this regard. We've already talked about how the FDIC, founded in 1933, rebuilt confidence in depository institutions and in the ability of people to save money. Today, the FTC insures up to $250,000 in deposits at participating institutions. Libertarian theorists can complain all they want about moral hazard, but it's an empirical fact that the FDIC has for 90 years successfully protected the savings of the mass majority of Americans, at least when you don't take inflation into account. The banking industry would be a fraction of its current size if it weren't for that success. The same goes for the stock market. In the same year that Congress created the FDIC, it passed the Securities Act of 1933, which imposed significant disclosure requirements on companies seeking to raise money from public markets. Companies have to produce audited financial statements, misrepresentation of which is a crime. Companies have to disclose risk factors that they know to be material to their success or face legal liability. Again, some libertarian theorists object to these rules as inappropriate government intervention in the private economy. And there were destructive policies enacted during the New Deal era. But the Securities Act of 33 and the Securities Exchange Act of 34 were essential in building consumer confidence in the trustworthiness of American financial markets. 60 million Americans have 401k accounts today because of the Securities Act of 33. So much of what makes our economy the envy of the world comes from the fact that the New Deal made our financial markets the envy of the world. These laws are what enable us to fund new treatments for breast cancer and new ideas for new businesses that make our lives easier and more affordable. Do you want to know how professional investors in traditional finance do their own research? First and foremost, they read SEC filings of the companies they want to invest in. If you told professional investors that in order to have a freer market, you wanted to abolish SEC disclosure requirements, they'd put you in a straitjacket and send you to an institution. Now, Gary Gensler, the SEC chair, believes all we need to do to fix crypto is to apply the laws of the 1930s to digital assets. It's not unfair of him to argue that many crypto tokens are basically blockchain versions of securities. But some of the most important digital assets are clearly not suited to regulation by New Deal era laws. Even Gensler concedes that Bitcoin isn't a security. Many stable coins aren't securities either, at least according to the Howey test, which defines a security as a contract with which an investor is led to expect profits. You don't profit from an asset whose value is designed to stay the same over time. And some digital assets, like Ether, have characteristics of both a security and a commodity. If we want people to have the same confidence in digital asset markets that we have in traditional financial markets, we need to design modern 21st century rules that align with the spirit of the securities laws of the 30s. The good news is that earlier this year, two senators, Cynthia Lummis of Wyoming and Kirsten Gillibrand of New York, introduced legislation that would go far in achieving that goal. Their bill, the Responsible Financial Innovation Act, would solve many of the problems I've talked about today by creating clear legal definitions and regulatory lanes for digital assets. The law makes clear, or the bill makes clear, that digital securities are securities that should be regulated by the SEC just as traditional securities are, and that digital commodities like Bitcoin should be regulated by the Commodity Futures Trading Commission, the CFTC. Hybrid or ancillary assets that don't fall clearly into one category or the other would be required to make certain disclosures to the SEC, but would otherwise be regulated by the CFTC. The bill would require stablecoins to maintain high-quality liquid assets equal to or not less than 100% of the face amount of their value, high quality defined as US currency, treasury bonds, or other well-established instruments. Together, these provisions would do for 21st century digital asset markets what the 1930s laws did to traditional markets. It's ridiculous that today, when we say do your own research, we mean read the white paper. Real research involves digging through legally binding financial disclosures and risk factors. Imagine if FTX had been required to make those disclosures about its tokens. Maybe the blow-up would never have happened. If you want major institutions to come into this space and drive real mainstream interest and trust in what we're doing, this is the framework we need. I'm taking the time to talk about this today because when the Lummis-Gillibrand bill came out, lots of people in our community didn't care. They saw it as just another attempt to impose government control over something that shouldn't have to kowtow to governments. I totally respect that libertarian philosophy, and I myself share a lot of it. What makes Bitcoin a tremendous innovation is its ability to always exist outside of government control. But the wider adoption and utility of the Bitcoin network depends on a clear, rational, legal infrastructure. We've been waiting for years for the SEC to approve Bitcoin ETFs. Grayscale's GBTC now trades at a 40% discount to the underlying value of Bitcoin. A clear legal framework for digital asset regulation will clear the way for the approval of ETFs, thereby serving as a major milestone in mainstream digital asset adoption. The Responsible Financial Innovation Act isn't perfect. I wish the bill did more to bar the Federal Reserve from ever adopting a central bank digital currency, for example. A CBDC is the single greatest threat to a free society that our government is seriously contemplating. Thank you. But overall, we're really lucky that the Responsible Financial Innovation Act exists. Not all legislation is so thoughtfully designed. Other bills that people in Congress are working on would be far less constructive and even extremely damaging to the ecosystem that we're all working so hard to build. Right now, between the November elections and the January inauguration of the new Congress, there's a danger that some random politician who wants to say he's cracking down on FTX puts some slapdash bill together that blows everything up. You will remember that infrastructure bill from 2021 that tried to define miners who do proof of work as investment brokers. Imagine something like that times 100. That's the kind of environment that we're in right now. The next few weeks are actually pretty critical. There are other things we can do to make the financial system of the 21st century more inclusive than that of the 20th. For one thing, we need to liberalize the accredited investor rules that prevent most people from investing in startups by purchasing so-called unregistered securities. We should liberalize the net worth and income requirements by allowing anyone who passes a basic test like the FINRA Series 7 to become an accredited investor. Thank you. Think of it like a driver's license for investing. Make the Series 7 free. Let people design online tutorials and learn the material, and allow the full range of investment opportunities, including digital assets, be available to everyone. We need a digital asset version of the FDIC that digital financial institutions can voluntarily participate in. In order for exchanges and other digital financial institutions to benefit from federal deposit insurance, they'll need to provide proof of reserves on an independently verifiable blockchain. If we do these things, one, provide a clear regulatory framework for digital assets. Two, make regulated digital assets accessible to those who aren't already rich. And three, create a system for ensuring the deposits that consumers park at exchanges and other digital asset financial institutions. We will massively improve the quality of the digital asset market in the United States. Robust transparency rules will make digital asset enterprises in America the most reliable in the world, attracting global capital to our shores instead of the other way around. We'll make sound money accessible to everyone who lives here. And we'll make it possible for Americans through voluntary and gradual evolution to restore balance to our debts and value to our savings. The history of money is full of tragedy. Monetary mismanagement led to the French Revolution and the rise of Nazi Germany. But thanks to Satoshi Nakamoto, we finally have the ability to transcend that history. That's why I'm so grateful for the work that all of you do, and why I know that with the right rules in place, we'll be able to accomplish more for the world than any of us can imagine today. Thank you.
I'm Lee Bratcher, the president of the Texas Blockchain Council. Thank you to everyone who came out to this year's summit, helping us make it the best one yet. Now more than ever, we need professional industry associations like the TBC to help craft effective policy instead of the CEOs of centralized exchanges roaming the halls of various state capitals or in DC. Texas is quickly becoming the center of the universe for Bitcoin, blockchain, and digital assets. If you want to be part of the future that we are crafting here in Texas, join the TBC today.